Giving season isn't just about good intentions, it's also a moment to take control of your financial future. Whether it's donating cash, stock, or goods, generosity can carry powerful tax advantages that many people don't realize. Joining us for Insight is Lawrence Sprung, founder of Midland Financial and the author of Financial Planning Made Personal. Good morning, Lawrence. Good to see you. Some donations are tax deductible, many of them are, but people aren't necessarily aware of what is and isn't and may not be making the most of it. What are the rules there that people should be aware of?
Yeah, so I think the first thing that people want to realize is that these tax deductions are available, and if you make donations to qualified 501c3s, they're often tax deductible, and the rules around it are very simple. You can deduct up to 60% of your adjusted gross income for cash donations, so to public charities where you write a check. But then some other options are you could donate appreciated stock or securities. Those are only capped at 30%, but there's a huge benefit because it allows you personally to avoid the capital gains tax entirely. And then if you end up making donations that exceed your available limit, you could always carry them forward for up to 5 years. So you want to make sure if you're going to be giving this giving season that you're doing it right and you're accounting for it properly.
And what kinds of non cash donations would you recommend if someone were to want to go down that path?
Yeah, so there are various things that you can do. One of the easiest things, especially with the stock market and investments rising, very quickly over the last 3 years, you could donate stocks, mutual funds, or other appreciated assets that you don't want to get the capital gains hit, because if you donate those, you can avoid the capital gains tax entirely by donating them rather than selling them. And it's really one of the smartest ways that you can support a cause, improve your tax situation, especially in the strong markets that we've seen over the last couple of years.
And talking here about smart donations, there's another aspect to this. You can also donate through your IRA. For some people, that could be a pretty wise choice. What have you got there?
Yeah, so a lot of people who are older, have IRAs, they're being forced to take what's called required minimum distribution. So the government says you're of age that you have to start taking out this amount, and that amount is completely taxable. So if you're taking out that money and you don't necessarily need it, if you're 70 and a half or older, you can transfer up to $108,000 per year. And every year that gets indexed for inflation. So that's the 2025 number. That will go up for 2026. You could transfer that 108 from your IRA to a qualified charity. This strategy is called a qualified charitable distribution. And essentially what it does is it allows you to donate to your charity of choice, lower your required minimum distribution, and it lowers your taxable income while you're in retirement. So it's really like a triple threat.
Yeah, this is all making charitable donations sound very attractive. And of course, it's doing good at the same time. But let's talk about why giving can be so good for the donor as well.
Oh, giving, the old adage used to be give until it hurts. And I think that's changed. And it's really give until it feels good. Give until you feel good. Because studies show that giving boosts your mood, reduces your stress, and even leads to better health outcomes. And, philanthropy really can also strengthen community bonds. And not to mention, if you have children, it shows and helps you set those values for children and reinforce a sense of purpose, especially when you align those causes with things that matter to you personally or to those causes that your family feels very strongly about.
Especially around this time of year, donations really do surge. So for folks who are thinking about it and going ahead and making those kinds of donations, what kinds of records should they be holding on to for tax purposes?
Yeah, so you want to make sure that you have those records, because don't forget that paperwork, because the IRS will ask you for it in the case of an audit or they want to check things out. So if you're making those cash donations and they're under $250, a bank record or a receipt is really enough. If you're making a cash donation over 250, you need a written acknowledgement from the charity. So you really want a letter acknowledging that you made this contribution. Now, if you donate goods that are worth more than 500, you clean out the closet, you get rid of your clothes, and you drop them off at the local shelter. For those over 500, you have to file a special form in 8283. And for donations over $5,000, you may need an appraisal. So bottom line is, keep this documentation, keep everything for at least 3 years in case there is an audit.
Very wise. Great advice. Thank you so much for your time this morning. Lawrence Sprung, good to see you as always.
Thank you.